All right, so this problem is available under Chapter 8 on our Blackboard in the instructor Zoom hours content folder. And I like this problem because, like I mentioned, we're tying in a party counterparty to a transaction. In this case, we're looking at a buyer and a seller, right? So Castor is the manufacturing company. So since they're manufacturing inventory to sell, then they are my selling company. They produce and sell goods to Pollux, who's a retail company. So Pollux is the buyer for Castor. And in this scenario, and of course, Pollux turns around and then sells what it buys from Castor to customers, right? This is a supply chain in action. But right now, we're not going to worry about the customers that Pollux sells to. We're just going to be thinking about the manufacturer selling inventory on credit to a retail company that's buying the inventory. Castor records cash discounts on credit sales using the gross method. So this is what we talked about in chapter 7. We're selling credit sales, gross method. They maintain a perpetual inventory system. Pollux records cash discounts on credit purchases using the net method and maintains a periodic inventory system. Right. So now we have these differences starting to surface. They're selling under the gross method, they're purchasing inventory under the net method. All right. Assume all sales contracts are FOB shipping. So basically, as soon as the goods are shipped, the purchase and sale can be recorded because title passes as soon as the inventory is shipped from buyer to seller. There's a $1 freight per unit paid by the purchaser on delivery. So we're going to be recording freight in as the purchaser since we're paying this freight and it's paid by the purchasing company. So on January 1st, Castor sells and ships 1,000 units of inventory at an invoice price of 100 per unit to Pollux. The invoice provides credit terms 310 and 30. The inventory had a cost of 60 per unit to Castor. All right, so Pollux is our purchaser, and we'll do them first. This is the Chapter 8 material. So we're buying on credit $100 per unit. Remember that as the buyer, Pollux, I'm doing the net method. So I'm not going to record these at their full price. I'm going to take them at their discounted price. So for Pollux and their net method and their periodic, to record this periodic net method purchase, first let's talk about periodic versus perpetual. They're using periodic, so that changes the account names. Periodic versus perpetual does not alter the dollar values. It changes our account titles. So here we're getting purchases, we're debiting accounts payable. Don't go on autopilot and record it as receivable. Just make sure you understand what side you're on. In the transaction, if we're the purchaser, then and we're buying on credit, we have something we got to pay in the future. So that just comes from my knowledge of it being a periodic system. Now, whether we use gross or net changes dollar value. So periodic v perpetual, this changes purchase accounts. So it changes whether I'm debiting purchases or debiting inventory, crediting purchase returns or crediting inventory. Gross versus net changes the dollar values. Because if we were under a gross method, well, I would debit and credit for 100 times 1,000, 100,000. But since I'm under a net method, I'm sorry, gross method, 100 times 1,000 units, that would be 100,000 full price. But since I'm under the net method, I'm going to take 100, get the after discount price because the net method assumes I'm going to take that discount and then apply that to the units of inventory. So I take that $100, multiply it by 97%, which is the after discount price, multiply that by the 1,000 units, and that's $97,000. Right? Both the purchase account and the account payable are expressed at that net of discount price. We also have the freight coming in that we have to attend to. If we pay for shipping $1 per unit, we have 1,000 units. Freight, don't ever, I never do discounts tied in with freight because again, freight tends to be to third parties, not between Pollux. That Pollux and Castor aren't going to be the ones shipping things. They're going to hire someone else to ship for them. So they're not necessarily getting any of these discounts. That's why I do freight separately. And under the periodic system, remember, freight is its own account, freight in, and we pay freight in cash. And that's going to be $1,000, 1,000 units and $1 per unit. So the freight in is that adjunct asset account, increases assets, and we paid cash for that. Notice we don't record any expenses related to the purchase of this inventory because we aren't going to record an expense, or in this case, cost of goods sold, until the inventory is sold by Pollux, right? Remember, we got to match the cost of this inventory to the period in which it creates sales revenue, which would be when we ultimately sold the inventory. All right, now Castor, on the other hand, is the seller. They sell under the gross method. They do maintain a perpetual inventory system. So let's get the sale down first. They're selling under the gross method. They record a credit sale, so that's accounts receivable. And that accounts receivable is full price because they're the gross method. And the full price of the sale would be $100,000. And the sales revenue would be recorded that as well. All right. This records the sale. Now we don't have to worry about freight because the buyer was responsible for the freight. We didn't have any transaction with the freight person. We do have inventory. Their inventory cost us, Castor, $60 per. And so because we're operating under the perpetual inventory system, anytime they make a sale, we have to adjust cost of goods sold. We have to adjust cost of goods sold with each sale. So we'd update this, debit cost of goods sold, matching it to the sales revenue as soon as it happens. $60 per 1,000 units would be 60,000. And because we're using the perpetual system, we credit inventory right away as well for the same amount. So that's the first piece of it. Notice the little bit of the symmetry here where we have the account receivable versus the account payable. These are mirror opposites, right? They're not recorded at the same amounts because one company is using gross method, the other one's using net. So that's why they're not perfectly symmetric. We have sales revenue here. We don't have any related expense shown here, which is okay again, because remember, in this case, we're not going to actually recognize the expense of purchasing this inventory until Pollux sells the inventory. So that throws it a little off kilter in that regard. Um, anyway, so then yeah, they don't have to worry about the freight, but these are our mirror opposites. I just noticed students sometimes have issues with letting go of the second word here, and they'll be recording accounts receivable for purchases. But that doesn't make sense because we can't purchase something and then hope to get money, cash given to us for the amount that we made and purchase, right? I would be purchasing things all day otherwise. All right. On 1.5, Pollock's return is 40 units, right? Assume that Caster has a refund liability of $1,000 prior to the return. So we're having some returns here. This, we can X this part out because while I didn't address it with my prior semester class, we have addressed refund liabilities. So this would be something that you're capable of doing. But let's deal with it from Pollock's side first, and then we'll discuss this and refresh our memory about that. So on 1.5, Pollock's is making an inventory return. Notice they haven't paid anything yet, right? They have the obligation to make a payment, but the only thing they've paid is the freight. So when they return the inventory, which they purchased by saying, look, we'll pay you later, then that means that their payable, the amount they absolutely have to pay for this inventory, is no longer $97,000. So that's the account we want to decrease. And we do it with a debit, which will reduce our obligation, our running total of how much we owe our vendor by the amount of the returns. So 40 units of inventory. And what did they cost Pollux? How did we record them? We recorded them at 97% of the full price times the number of units. And we're going to maintain that same valuation. Okay, so the net method sets the dollar value for these. So that's $97 times 40 units. And comes out to 3,880. Now the credit goes to purchase returns, also at 3,880. Just remember that when you're dealing with gross or net method, that sets the rule for how we value each unit. Okay. If there is a refund of freight, which I typically assume, and I didn't put in this particular problem, but if we have a freight refund for anything we return, then we would get that back in cash. In this case, it was $1 per unit, so we get back $40. And we credit freight in. And this is just one asset for another. Now, on the seller side, they're getting a return. So we reduced our payable with these people, and they need to reduce how much they expect us to pay them. Now, in this case, we have $40 of 40 units of inventory. This is the inappropriate price. It should be $4,000 because how did Caster value each sale? Well, it was using gross method prices. So it would use gross method price, $100, multiply that by the 40 units it got back, and that would be its amount. Oops. That it records as inventory coming back, and reducing the amount they think we owe them. It comes out of refund liability, remember, not sales returns, because in first thing we do is debit the refund liability until it has a zero balance. Once that's at zero balance, then we start debiting sales returns and discounts. But we have, oh, actually, because I made the mistake with math, I do have to make an alteration to that piece. My refund liability stops at 1,000. The sales returns would then make up the remaining piece, 3,000. And the credit to accounts receivable still remains at 4,000. So the refund liability reduces liabilities. The debit to sales returns, remember, that's a contra revenue. So that reduces net income. And the credit to accounts receivable reduces assets. In terms of this entry, what is this entry doing? Basically, when Caster sold the inventory, they recorded cost of goods sold for the entire amount that they sold, right? All of the units, all 10,000 units at 60 per unit. But since 40 of those uh, since 40 of those units are coming back now, we did not sell off $60,000 worth of inventory. We should not recognize cost of goods sold for 60,000. Rather, we should recognize now $2,400 of inventory coming back. And how do I get that? Well, we had $60 cost, not sell price, but $60 cost was the amount it cost Caster to make this inventory. So that's where how Caster values the inventory times the 40 units that came back. And so it would reduce the cost of goods sold by 2,400, which ultimately increases net income, and it would increase its inventory by 2,400 because it did not actually sell off the 60. And again, what really is behind the idea of the valuation is Caster uses gross method. And so we do full price there. On 1/8, Pollux pays for 480 units of the inventory it kept. So, right, it bought 1,000 units. It returned 40. And so there was 960 units that were kept. And that's just from the total 1,000 bought, 40 returned, which gives me the 960 units it kept. So if Pollux is paying for that now, and we're on 1/8, right? We purchased it on 1/1. We're 7 days after that purchase date. That means that we're within the discount window. So we get the 3% discount. So the amount of cash I pay is going to be at the $100 times 97% because we paid in discount times the number of units it paid for. So $97 per unit, and we paid for 480 of them. That's 46,560. Remember, we're paying cash because we are the purchaser. Now the question becomes how much does this cash pay off in terms of the payable? Well, what did we record the payable at? Was it full price or net of discount? And because Pollux is Going with the net method, it recorded because net of discount or because net method, we would record this at the discounted price as well. 100 times 97% times the 480. So because we had a net method approach as the buyer and we paid in the discount, we paid discount cash. We don't have any extra accounts that need to come in between the two. This is at the discount amount because it was paid within the discount. This account is discounted terms because we use the net method. So they align. Will it align for Castor? Let's see. So Castor receives the cash. And in a party counterparty transaction, the cash will never be distinct because the amount of cash exchanged is true for both parties. There's no accounting conventions that can change the exchange of physical cash. And so this is always going to be recognized at the same amount. Now, the difference in accounting arises because Pollux can set the terms of how it records its payable. They set terms that they record their payables by net method. Castor can set terms in how it records its receivable. The terms it uses are the gross method. So this is where the differences can start to really arise. That the manufacturer is receiving this money from the retailer that they sold the inventory to. And when they receive that money, they no longer have the expectation to receive what they have gotten. But how much do we want to record this for? Remember, now this is at the 100% value because the gross method. So we're going to do the full price, $100 times the units that are in question for this particular transaction, 48,000. The credit to accounts receivable reduces assets. Now, of course, we have a differential going on here. And why did they receive less cash than they expected to receive from their client? Because they use the gross method. They assume that discounts would not be taken. They were. So they got paid less cash than they had expected. And we record a sales discount for that differential. Reduces net income. And the differential here turns out to be 3,440. And we have no freight here, nothing else going on, no cost of goods sold to worry about because Pollux hasn't sold the inventory to someone else. And this is just Castor recording the receipt of cash from a prior credit sale. All right. Now we're on 119, clearly outside the discount because we bought it all on 1/1. That's 18 days. The discount terms say that we had to pay in 10 days. So we're outside discount, which is going to switch things, right? Because Pollux records using the net method. Their payable is still being valued at net of discount prices. So they take the $100, multiply it by 97%, multiply that by the 480 units that it is paying for, all because we're talking about the account receivable and I'm sorry, not receivable, the account payable. And those valuation terms are set by the method they choose. In this case, net method. Now, they're paying, this is a net amount, they're paying outside the discount. So the amount of cash they pay is going to have to be full price. This is 100% outside discount. So the cash changes based on whether we're paying in the discount or not. So that's the 100, the full $100 multiplied by the 480 units, which we've done the math for up here, $48,000. Now, again, we have this discrepancy between the payable that is being reduced versus the amount of cash that was being paid to reduce that. And once again, we have this issue where we're like, why am I paying $48,000 cash and only getting 46,560 taken off my outstanding payable? The idea is we're having to pay extra because we had purchase discounts forfeited. That is a reduction to net income for 3,440. Now on Caster side, remember their gross method. So they're receiving that full price cash, 48,000. That's always linked in these party counterparty transactions. The credit though to the receivable, since they record the receivable always at full price as well, they're also going to recognize a credit to receivable for 48,000. So that's full price due to gross method, right? That's what sets the terms there. The cash is full price due to being paid outside discount. So understand that distinction between full price and net. And then if there's any discrepancy to talk about, reason through it. Why did I pay more cash to take off a lesser valued payable? Oh, because I recorded the payable net of a discount that I ended up not taking. All right. Now, the last piece, this is when Pollux finally sells not so remember Pollux is my retailer, the guy who's been buying this inventory from Caster and paying it off. Now they finally turn and sell it to their customers. And they sell 300 units that they purchased on 1/1 for $190 per unit, and they paid delivery fees of $30 to complete the shipment. And they have credit terms, right? So they are also selling on credit. Um, and when they sell, it says Pollux records cash discounts on credit purchases and sales. So they're using the net method for both. When they make this sale, they become the seller. So then they have an account receivable. And just know anytime credit terms, if there's credit terms, then that means we made the sell on credit or the purchase on credit. Cash sales do not have credit terms because cash is already paid. So this account receivable would be for the $190 it charges its clients. But because they use the net method, they'll assume that their clients are going to take that 2% discount. So we should only have 98% remaining. And we sold 300 units. So we just do that math, take that product, and that is 55,860 for the receivable and the sales revenue. If Pollux is paying delivery fees of $30 to ship to its customers. So these are delivery fees paid by the seller. They're paid by Pollux, who is the seller. because it's selling to customers. Then it's not freight in anymore because freight in implies it's coming to us in, but this is freight out. So really what it becomes is shipping fees. So freight in is only used when we're purchasing inventory, bringing it to our place of business to be sold, not when we're paying to have it sold and shipped somewhere else. In that case, shipping fees are just a selling expense, reduces net income, and also cash. And it just said $30, not 30 per unit. Now, the one thing that's different between Castor when it made its sell and Pollux here is, well, first the shipping, because the shipping was on the seller for Pollux, right? So they had to pay the shipping fees. Whereas over here, Pollux was the buyer and it paid the shipping fees as the buyer. So there's a difference. The other difference is I am not going to record cost of goods sold inventory as I did here down here. And the reason is Pollux uses periodic system. And the periodic system does not update COGS and inventory at point of sale, right? Castor was using the perpetual, and perpetual does update inventory at the point of sale. We have no entries needed here for Castor because they're not involved in this transaction unless they happen to be a customer of Pollux, but they would be kind of silly to sell something and immediately rebuy it at a marked up price. So I'm guessing they're not a buyer from Pollux, and so they don't have a part in this particular transaction. Um, I like this problem again because it does the party counterparty. It shows how what we learned before is really just a mirror image of what we're learning now. And I have another example that's similar to this with two companies, different scheme, but yeah, buyer, seller, one uses gross, the other uses net. I'll put it up and let you work on it. I think it's a good experience to go through and just make sure you understand all these purchase entries and then again relate them and link them to things you learned before so that you bring everything with you.